As the summer of sports kicks off and a UK election looms, there's been plenty happening with the markets and with stocks over the past month. Hi, I'm George, Founders Investing Expert. This month, we've partnered up with Interactive Investor to bring you all of the latest market news. If you're interested in more content like this, do me a favor and make sure to like below and subscribe to our channel. In the middle of June, around about the 10th, Nvidia shares went through the process of a 10-for-1 forward stock split, which just means that every single Nvidia share turned into 10 shares. So if you were holding one full share, you'd automatically get 9 more. Now, unfortunately, this doesn't mean that shareholders became 10 times richer, because a stock split doesn't actually add any value. It just increases the number of shares that are in circulation. But it does make the shares more affordable to investors, especially those who don't have access to fractional shares. So to give you an example, if you had a single Nvidia share worth roughly $1,000, you'd now have 10 shares worth roughly $100 each. Now, this stock splitting is quite common, and it's something that we did see a few years ago with Tesla when the stock price started skyrocketing and the shares became more popular amongst retail investors. And again, in theory, it doesn't add any value, but Nvidia's share price did react quite positively, and it actually ended up overtaking Microsoft to become the world's most valuable company, which is kind of crazy because if you speak to a lot of people outside of investing and finance, they're gonna have no idea who or what Nvidia is because it's not exactly a household name like Apple or Amazon. However, after reaching the top spot, Nvidia's price did pull back and it did lose that kind of first place. And by the time this video comes out, it may have dropped even further, or it might have regained the throne as the world's most valuable company. Whatever happens, it's been an absolutely crazy year for Nvidia. The UK headline inflation rate is down to the 2% level. So prices are still rising, but now they're just rising at the Bank of England's target level. Overall, this is good news for the stock market because of the possibility of cuts to the base rate in future. Now, a lower base rate means that there's less incentive to save, there's more encouragement to spend money, and people and businesses can have high levels of disposable income because borrowing costs can be lower. Now, higher inflation does tend to be a better environment for value stocks and those that are generating a lot of cash today, and that's something that we've actually got a lot of here in the UK. Whereas lower inflation tends to be better for growth stocks because of something called discounted cash flows. And in short, this just means that because with high levels of inflation, money made in the future is worth less in real terms because the value is being eroded by rising prices. But growth stocks are something we don't actually have a lot of here in the UK. And we've actually seen UK stocks perform quite well in recent months. We had the FTSE 100 index reaching all-time highs, and that just tracks the 100 biggest companies in the UK. And it's also up by around 7% in the last 6 months. So it's going to be interesting to see how the latest inflation data actually impacts UK stocks going forward, because it might actually dampen performance. Cambridge-based computer maker Raspberry Pi, that's Pi PI, went public with a listing on the London Stock Exchange under the ticker symbol RPI. After ARM decided to list in the US, it was a bit of a relief to see an innovative UK company actually willing to list here. Although the shares were listed on the 11th of June, most investors couldn't actually buy shares until the 14th of June, which is when we saw the share price kind of rise and then eventually peak on Monday the 17th before falling back down. It was actually quite an unusual IPO because from that date on the 11th of June, there was a period of conditional dealing. And this just meant that only institutional investors could actually place orders to buy shares, lasting a few days. But also, if the IPO wasn't received well, Raspberry Pi could kind of pull the plug on the whole thing. And it's a way for them to sort of test the waters and see how they were going to be received, see if the shares would be a hit or a miss. And there's a bit of a backdoor for them to exit if things kind of turn sour. Now, it's quite common for the share price of a firm to be pretty volatile in the weeks and months following an IPO. So yeah, just watch out for that if you're thinking about investing in Raspberry Pi. The listing is definitely a positive sign for the UK market, and another IPO shows confidence is kind of returning after quite a few drab years. And we might see new listings ramping up throughout the rest of the year, like here and in the US as well. So keep your eyes peeled. There might be some big news incoming soon with fast fashion firm Shein, which could be listing here in the UK and snub in the US. And if you want to buy shares in Raspberry Pi following the recent IPO, you can get access to the newly listed stock on various trading platforms, including Interactive Investor. With the announcement of a general election taking place in the UK on 4th of July, sorry to kind of, take the shine off American Independence Day, I've seen a lot of videos and emails, podcasts, just about everything you can imagine, going on about the topic of what does this mean for your investments or how to invest around the election. Now, it is likely that we could see a bit of a temporary weakening or strengthening of the pound, and a move either way in UK currency can have an effect on your investments, but it does depend on what you're holding and how long this kind of fluctuation might last. The truth is, it's kind of impossible to say exactly how markets will be impacted. What will likely happen is a period of, volatility and price movement around the dates of the election, because the markets just hate uncertainty. Now, this could remain the case for weeks or months after. However, the best way to avoid an impact on your portfolio is basically to do nothing. Realistically, this next general election shouldn't have a huge impact on the way that you're planning to invest for the next 5 to 10 years. Especially if you take a look at the manifestos for all of the main parties, and there's nothing completely radical being floated. So it's worth just carrying on investing as you normally would, and be wary of trying to time the market around this period. It's spoken about a lot, but ideally you should just be aiming to keep a diversified long-term approach, because there's always going to be something unexpected happening, whether that's an election, a war, a pandemic, or even just England playing attacking football at the Euros. Thanks for watching. Make sure you tune in next month. And if you want to check out our review of top trading apps like Interactive Investor, just click the I over in the right-hand corner or click here for our latest videos.